Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure recognize two official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Hello everyone, welcome to Qingyi. Good evening. Today is Tuesday, December 23rd. I'm analyst Jang Jita. Please remember to like, subscribe, and share to support us. If you have any investment questions, feel free to leave a comment. If I don't get a chance to answer today, I'll go over them one by one in tomorrow's class. Of course, there are only a few trading days left until 2026, so after this week's live stream, we'll be heading into 2026. So whether you're facing 2020 or, as the old saying goes, when it comes to your positions and exposure, it's best to manage them properly. Because a lot of you might be thinking that with the Christmas holidays or the New Year coming up or the so-called Christmas peak season, there might be some market moves to look forward to. If you're looking forward to a rally but haven't taken action, then the positions you hold and the type of stocks you're operating with become especially important. Of course, as we move into next year, we'll have a lot more follow-up content to share with everyone. And of course, if you have any investment questions, feel free to leave us a comment. All right, good night, everyone. Hello to everyone. Just now online, we have Hui Jun, Mei Daizi, good evening, and also Yu Lunge. And Fei De Yu, good night, as well as Alice Fool, Ki Pao Shui, and Anaya. Good night, good evening, good evening. All right, let's get started. First, let's take a look at today's investment highlights. Today, we can say that as we approach the end of the year, there are a lot of economic data releases and updates being announced. So the most important data this week is actually coming out today. Tonight, there will also be some announcements, and we'll preview and track them together with everyone. First, let's look at Goldman Sachs backing the Magnificent Seven. So why exactly is Goldman Sachs supporting the Magnificent Seven? So what exactly is Goldman Sachs's profit forecast for the Magnificent Seven, including next year? Why at this stage are they looking ahead to 2026? You'll notice that many investment institutions are gradually starting to share their views on related sectors and industries, offering their outlook for 2026. Goldman Sachs is taking the lead, presenting a relatively optimistic view on the Magnificent Seven. What exactly is their positive outlook? We'll be providing more details on that today. In addition, Trump's foreign policy is also very important. This year, starting from February, March, and April, there have been continuous moves, all the way up to the end of the year. What is this about? It's the so-called trade war between the United States and the rest of the world. Of course, the key point in the U.S. trade war with other countries is how the U.S. negotiates and communicates with other nations on trade issues. Another aspect is what we call not holding back. So what does not holding back mean? Today, Trump has been gradually replacing and dismissing many officials in embassies and diplomatic positions. What is he planning? He wants to place his own people in these roles. Which countries have had their officials replaced? And do these changes have any connection to next year's trade war or the upcoming election? Is there really a connection? In a moment, I'll analyze it for everyone, one by one. But you need to remember this move. Trump's replacement of embassy personnel is closely tied to what will happen next year. Just wait and see. Now, as for the industry side of things, Michael Burry, the real-life inspiration for The Big Short, has once again criticized NVIDIA. What exactly is he criticizing? Besides that, how does it relate to the AI industry? As we all know, Burry has previously criticized companies like NVIDIA, Tesla, and even Oracle. Especially with Oracle, its performance in the second half of this year has been extremely weak. With Oracle's stock price continuing to slump, you can see that among investment banks, there's one called Wells Fargo. Today, however, they have put forward a different opinion. They believe that Oracle stock is actually undervalued. So what's the reason for this undervaluation? With the stock price having dropped to its current level, if you're looking to buy Oracle at a relatively low entry point, is now a good time to get in. That's something we need to pay special attention to today. Good evening, everyone. First, let's take a look at the economic data. Tonight at 9:30, let me give you a preview. We'll go over it together at 9:30. The main releases include things like third quarter GDP, core PCE, personal consumption expenditures, and so on. All right, in addition, for the Q3 annualized GDP growth rate preliminary reading, the previous value was 3.8% and the expected value is 3.3%. Also, for the Q3 personal consumption expenditures growth rate preliminary reading, the previous value was 2.5% and the expected value is 2.7%. Go ahead and jot down these numbers first. For the core PCE growth rate preliminary reading in the third quarter, the previous value was 2.6%, and the expected value is slightly higher at 2.9%. For these key data points, just focus on comparing them to the expected values. That comparison is basically enough. If the release data, whether it's the Q3 GDP, personal consumption expenditures, or other figures, are about the same as the expected values, or even a bit better, then that means the US economy isn't in recession. Now, the third data point, the core PCE, is more closely related to inflation. The expected value for this is 2.9. If the data released at 9:30 turns out to be lower than 2.9, what does that mean? It means that inflation isn't out of control. And if inflation isn't out of control, that's good news for the Fed to consider cutting interest rates next year. So these three data points are pretty important. Just pay attention to what I just mentioned, Q3 GDP and Q3 personal consumption expenditures. What kind of trend should we be looking for? If it's better than expected, that means the overall economy is solid. There's really nothing to worry about. As for Q3's core PCE, ideally it should be lower than expected, below 2.9. If it's below 2.9, that means inflation isn't out of control. And in this situation, monetary policy is more likely to be on the accommodative side. Also, at 9:30, there's another important data release, the U.S. durable goods orders for October. Of course, since this is October data, it's a bit dated. The previous figure was 0.5, but the forecast is a decline of minus 1.5%. Then, at 10:15 p.m., there's also the U.S. industrial production data for November. Both the previous and expected values are 0.1%, so this data is relatively neutral and not very important. So you can just take a quick look at it. Then, at 11 p.m., if you can't sleep, you might as well check out the latest data for December, which is the Conference Board Consumer Confidence Index. The previous value was 88.7, and the forecast is for a rebound up to 91 points. You can see that the Conference Board's Consumer Confidence Index has actually been declining steadily since 2021, and now it's basically at a relatively low level, continuing to drop. Of course, whether it's due to the impact of Trump or other factors, various situations like these have caused consumer confidence to drop quite significantly over the past year or two. As for when this data might have a chance to rise again in the future, of course, I think next year, if Trump still has a chance to roll out some decent economic policies, like if the tariff war can be eased and he pushes out a lot of attractive policies for the election, then I think there's a good chance that consumer confidence could rebound again. So keep an eye on this data point at 91. Lastly, in December, the Richmond Fed Manufacturing Index is relatively less important. It's released at 11 p.m., with the previous value at minus 15 and the forecast at minus 10. So to sum up, there are about 7 data points to watch. Of these 7, I think the most important will be the 4 released at 9:30. Third quarter GDP, personal consumption expenditures, third quarter core PCE, and the monthly durable goods orders. We'll be tracking these 4 data points together at 9:30, and they're also among the most important economic indicators to watch today and this week. All right, good evening, Yolan. Good night, good night. That's the update on the data for everyone. As for the officials, you need to pay attention to their statements. Sometimes these officials change their tone from one day to the next. One moment they're dovish, the next they're hawkish. One says there will be a rate cut, then someone else says there won't be. They just keep changing their minds. But no matter how they change, after Christmas, what we face is New Year's. In 2026, there will be a lot of new variables, new data, and new officials taking office or stepping down. And this also includes something very important next year. The US midterm elections will be underway. That's in November next year. So before the US elections in November, you'll actually see a lot of positive news, favorable policies, economic boosts, and easing measures. If the Republican Party's poll numbers go up, it benefits the US economy and the stock market. Because if the stock market isn't doing well and the economy isn't doing well, it's hard to win next year's election. Milan mentioned today, a 50 basis point rate cut? Not the case. He used to say in previous times that it was absolutely necessary to cut rates by 50 basis points, but today he suddenly took the opposite stance. He said that the need for a 50 basis point rate cut has somewhat diminished for now, and he hasn't stated how much rates will be cut next year. Also, if his position as a board member expires at the end of January next year, he mentioned that at the end of January next year, since he previously took over this new board member position temporarily, if there isn't a new candidate by then, he might stay on. I think the chances of him staying on are pretty high, especially considering the past few interest rate decisions. He kept loudly insisting during those meetings that everyone needed to cut rates by at least 2 notches, by at least 50 basis points. Otherwise, he said, it would be letting someone down. Not just the current stock market, not just the economy, but also Trump. So given this level of loyalty, I think by the end of January next year, once his term ends, there's a chance he might be reappointed. In addition, CNBC mentioned that Trump might announce the new Fed chair as early as the first week of January next year, which is actually just about 2 weeks from now. Currently, Hassett has about a 61% chance of winning the position. As for the chances of being appointed, you should also keep an eye on other candidates like Walsh and Waller. These 3 officials are all relevant contenders. No matter who gets selected, things will pretty much be settled next year. Whoever is chosen will, to put it bluntly, become a very important piece in Trump's monetary policy game, and that includes Milan as well. That's why I say Milan might be reappointed at the end of January next year, because Trump will want to keep using him. So what about next year? If the new Fed chair is really announced in the first week of January, that person will definitely be someone who supports Trump's dovish monetary policy. So overall, next year's monetary policy will likely be dovish all the way. As for Goldman Sachs, why does Goldman Sachs say this? Why do they say they're more supportive of the tech giants? Because as everyone knows, this year's market has been like this. 2023, 2024, and even into 2025, we've seen a 3-year bull run. Whether it's the US stock market or the Taiwan stock market, they've both been climbing steadily upward. This year's market is special. 2025 is the 15th year. Earlier, we discussed the year of the snake. The snake itself is volatile, so there are more surprises. Though 2025 is a bull market, its movement differs. At the year start, it surged, but February to April, it dropped steadily. Since April-May, market recovery has been tough. When it tries to rebound, it seems to hit a new high, winding and twisting like a snake. So this year's market, though final results show this year's, I remember the return rate, be it Dow Jones, NASDAQ, or Philadelphia Semiconductor Index, the semiconductor index rose significantly. The gains have all been very high, probably over 20%. So this year, the indexes have continued to rise by another 20% to 30%, which is really impressive. So what about next year? Next year is the year of the horse. How should we look at it? We'll have time to talk more with everyone about related issues and what might happen next year. Each zodiac year, the stock market has its own trends. We'll share more next year. 2023, 2024, and even 2025 have been hitting new highs. As for next year, 2026, the chances of another rise? The chances of this trend continuing are also very high. The saying, success comes swiftly, for the year of the horse applies. The most important factors are next year's relaxed monetary policy and US midterm elections. So the bull run could extend into a 4th year. What to do in this 4th year? We'll share next year. Next year, the 4th year, the market is likely more bullish, but key points in stock holdings and trading strategies will differ from this year. This year, the market was very volatile, with big ups and downs. Especially in 2012, fluctuations were extremely large. Next year probably won't be like that. Still, we'll update everyone on any risks that may arise. All right, so that's what Minan and Hassett were talking about. Now, what did Goldman Sachs say? Goldman Sachs, as we just mentioned, said that 2023, 2024, and 2025 are all bullish years, right? And usually the main driving force pushing the index upward is the Magnificent Seven. So what did Goldman Sachs say about next year, 2026? The overall profits of the Magnificent Seven will account for more than half of the total profits of the S&P index, about 46%. Compared to this year, where in 2026 they contribute 50%, that's a slight decrease of about 4 percentage points. Honestly, that's not a big difference, but overall, it's still close to 50%. In other words, they believe that in 2026, the Magnificent Seven will likely continue to lead the entire S&P 500 index. What does that mean? It means that more than half of its profit growth will still depend on the Magnificent Seven. You can easily think about which industries the Magnificent Seven cover. There's AI, CSPs, social media platforms, Apple smartphones, electric vehicles, consumer products, and so on. There are a lot of different things involved. Since the scope they cover is extremely broad, and the competitive moats of these 7 major companies are also incredibly high, honestly, if you really don't know which stocks to buy, if you're unsure about how to choose in the world of AI, or in consumer electronics and consumer goods, or even if you don't know about companies like Google or Meta, if you're not sure about social media or, well, social media platforms, if you're wondering which company to buy for things like internet search, you should basically focus on the big 7. Next year, these 7 giants are still likely to perform well. The chances are pretty high. So according to Goldman Sachs, they estimate that next year, these companies will continue to contribute nearly 50% or more, which is quite likely. Regarding the US Federal Reserve, profits project at 4.13, with the terminal rate at 3.65. These numbers will gradually change next year. We'll update you. Today, I'm adding one more chart for 2026. You can see for 2026, there's little point in looking at this year, with only about a week left. Let's take a look at the market expectations for the end of 2026. What are the market's expectations? For the whole year of 2026, how many times might interest rates be cut? The number of rate cuts may be around 2, about 2 times. As for whether these 2 cuts will happen in January, I think that's unlikely, because there was already 1 cut in December this time. If I'm not mistaken, there have already been about 3 rate cuts this year. Looking ahead to next year, if we go by what Powell and other officials are saying, there probably won't be any action in January next year. Rates will likely remain unchanged in January. If things move quickly, maybe rate cuts could happen in June or September. Why? Because there's an election in November. Since the election is in November, it's easier to cut rates in June or March, as that's around mid-year. Then, in September or at the end of September, there could also be a chance for a rate cut, because after that, November is for the election. By that time, the Fed chair will have changed, and the new chair will likely be someone more inclined towards easing. someone who supports Trump's policies, so it looks like the second rate cut will probably happen around September or October next year. After the rate cut, things will go back to being all rosy again, which just so happens to coincide with the election. So I think next year there will probably be one rate cut in the first half and another in the second half of the year, something like that. Anyway, as for the gradual lowering of interest rates, we'll keep tracking the forecast values together when the time comes. As for the US dollar index, it continues to be relatively weak because Trump wants to cut rates. Today, it dropped another 0.27%. Overall, in the short term, it's still on the weaker side. Nothing has changed. Really, nothing has changed. All right, let's take a look at something else. Thank you so much, teacher. Okay, thank you. Coco Lee, yeah, it really does take quite a bit of time. It takes a lot of time. Good evening to everyone working. Good evening, Merry Christmas, Merry Christmas. Actually, every one of our teachers, whether it's from the morning, or switching up the benefits, or for example, some teachers who usually take the morning shift, like Shirun Zheng, Teacher Shi, Huang Peng Rui, and many others, like Dong Jiaqing, and so on. There aren't a lot of teachers who take the morning call, including some Chinese teachers as well. Of course, for the Good Night program, there are also many teachers involved. After finishing the morning shift, some people might have to do the Good Night live stream the following week. Actually, collecting all this information really does take a lot of time. It really is time consuming. Especially for the morning call when the live stream sometimes starts at 8 in the morning. I know because I've done it a few times before, and I usually have to get up at around 3 in the morning to prepare. 3 in the morning, before the roosters even crow, before the sky gets light, before the dogs even bark. That's when you have to get up and start looking at things. There's no local stock market to watch yet, so you check the European markets, start gathering information and writing. You also have to prepare some related things for the Taiwan stock market, probably bit by bit the day before. Then you keep track of the closing prices, the data, and the news all the way through. I remember I used to organize everything until about 6 o'clock, maybe 5 or 6 in the morning. Then around 7, I'd take a short break, have some breakfast, and then start the live stream at 8. So doing the morning shift, honestly, it was really tough, really exhausting. After going through it a few times, I realized my body just couldn't handle it. I decided to stick with the night shift instead. When my energy level is better, whether it's the morning briefing or the evening live stream sharing, I really hope that everyone who joins the program can gain something from it, no matter if you're a beginner or a seasoned investor. Everyone can exchange ideas with each other. Maybe sometimes during this process of communication, not every single piece of data or interpretation will be 100% completely accurate. I hope everyone can be understanding about this because after all, sometimes time is limited and things can be a bit rushed. About 90% to 95% of the data for each case will be accurate, but sometimes, due to time constraints, that remaining 5% might not match exactly what everyone expects. Anyway, looking ahead to 2026, I hope everyone will continue to support us at Capital Securities Investment Consulting and Capital Securities. Now, regarding geopolitical risks, how should we manage our positions? Caesar asked about how to handle cash positions right now. Should we operate the same way as this year? Basically, my current approach is to keep my positions at around 50 to 60%. Since the index keeps hitting new highs, my view and my strategy are actually the same as before. Of course, I just wanted to share this with all of you. Whether your approach is more conservative or more aggressive, everyone might have different ways of managing their positions. As for me, my strategy is relatively neutral, but slightly on the aggressive side. So neutral, not really conservative. I'm neutral, leaning a bit aggressive, but I'm not what you'd call a high risk taker. That means at most, I might use 60 to 70% of my funds for investments, but I basically always keep 20 to 30% in cash on hand. I never go all in, so my approach is more, well, it's more about active management, but I tend to stay in the middle ground. So if you have a similar mindset as I do, let me just share a bit of my thinking with you. Right now, the market index is relatively high. So what I do is whenever I see a new high, whether it's an individual stock or the index itself, whenever there's a new high, I always sell a portion first. I always sell a portion first and put the profits in my pocket. I keep it aside, and then if there's a pullback, when the price comes back down to the moving average, whether it's an individual stock or the index, when it hits the moving average, I consider buying at a lower level. So basically, I trade back and forth. When it's high, I sell. When it drops, I buy. That's the approach I take. And as for my overall position size, I basically never go all in. It will never be 100%. I usually invest about 60 to 70%, and then I keep the remaining 30% to add more if a really good opportunity comes up. That's just how I do it. So everyone can use this as a reference, just for your consideration. As for the teacher's predictions for 2025, honestly, they're just okay. Not super accurate or anything. Actually, what we do is, like President Fan always says, we just keep doing, observing, and adjusting as we go. Sometimes our views aren't always 100% correct. It's really a process where we all learn from each other. When we're wrong, we make adjustments. And when we're right, we still approach things steadily and conservatively. That's pretty much how it is. Of course, I hope that whether it's 2026 or any other year, everyone can become more and more steady on their investment journey. Steadier and steadier. Let's all keep working hard together, okay? Keep it up! Now, regarding the risks related to energy sources, let me talk about this pulling up stakes journey and foreign policy. What Trump is doing right now is especially important. What is he doing? He's laying out plans for next year's foreign affairs, possibly even a trade war, and the election. What is he setting up? Today, he said he wants to reshape America's diplomatic strategy. He's pulling back about 30 diplomats, ambassadors, and other diplomats, which involves about what is he trying to do in these countries? He wants to replace these diplomats because most of these diplomats, envoys, and embassy staff were appointed during Biden's administration and have stayed on until now. It's expected that by the end of January next year, there will be a change of personnel. So he's starting to make arrangements. Why? Because on one hand, these diplomats were all appointed during Biden's time, so some of them might have policy views that lean more toward Biden or the Democratic Party. That's why he wants to do a major overhaul all at once. Replace people. Replace them with whom? He wants to replace them with people who support Trump and the so-called America First policy, so that's why he's bringing them in. In other words, he's arranging for the ambassadors and embassy staff in these 29 or 30 countries to be people who stand with Trump and are more supportive of the Make America Great Again and America First policies, so they can negotiate and strategize with other countries, whether it's in foreign policy or economic policy. When it comes to trade exchanges, these embassy staff members are extremely important, because what do they represent? They represent extensions of Trump himself. It's just like Sun Wukong. Sun Wukong could pluck a hair and create 72 clones of himself. So Trump thinks of himself as Sun Wukong, arranging for these embassy officials to be his shadow warrior, so to speak. That's the idea behind what he calls shadows. They're like his clones. So among these embassy staff members, I think that's why he would say this. Looking ahead to next year's trade war and the election, because after replacing them, it means that all of them will be carrying out Trump's policies, especially these countries where the officials have been replaced. Why is this related to the trade war? Because the countries where he made these changes, let me tell you all about them. African countries are the most affected. With 13 of them, 13 ambassadors have been replaced. In addition, 6 Asian countries have had their ambassadors replaced as well. So for example, out of 29 countries, 19, more than half, out of 29 countries, 19 are all from Asia and Africa. So why is the focus on replacing ambassadors in Asia and Africa? Why Asia and Africa? Because when China and the US were engaged in a trade war, which countries did China keep trying to win over? Africa. They wanted to develop economic ties with Africa to engage in trade. And then as for Asian countries, why does the US want to quickly replace the relevant personnel? And then to have even closer cooperation and ties with Asian countries. Now, which countries are included among the Asian countries? Japan, South Korea, Thailand, Myanmar, Laos, Vietnam, Taiwan, all of these. Why does the US want to replace people in relation to these countries? Because when they put their own people in place, these people, what can they do? They can convey Trump's intentions, unite these countries together to resist China, or work together to contain China. It's kind of like what we talk about with the Pacific Island chain or something similar. Basically, a series of connected efforts like that. So why does the US want to replace people in Africa? It's because after they appoint new embassy staff, what can they do? They can gradually rebuild friendly relations with African countries. Why? It's to pull out the roots that China has planted there. Those countries that originally had good relations and strong trade ties with China. At this point, when Trump steps in, he will use these ambassadors and embassies to send a message. As long as you maintain good relations and communication with the United States, the benefits you receive will be greater than what you get from China. So why is it that out of 29 countries, 19 are in Africa and Asia? I think a huge reason is that Trump wants to gain control in next year's trade war, hoping to secure more and powerful allies and more strongholds to help him. For what purpose? To confront China. So think about it. Out of those 29 countries, he's not swapping with countries like Canada, New Zealand, or other mainly Western countries. Maybe there are a few, but for the most part, more than half are Asian and African countries. I think a big reason for this is for next year. This is all part of the trade war strategy, and of course, there are a lot of considerations on the road to the election as well. Anyway, we'll just keep watching how this plays out. This big move of swapping partners, I think it could affect next year's trade negotiations. Once the meetings for next year are scheduled, we'll take another look at it. It's totally fine to hold your stocks through the new year, or even for a whole year. Anyway, if you want to hold your stocks over the new year, hey, good evening to Jeff Lin, and good night to Luis Yang. Whether you want to hold your stocks through Christmas or the new year, it's all up to you. Either way is fine. Let's talk about something a bit more practical. If before the new year the stocks are holding or making money, then you might as well keep holding them and welcome the new year. But if some of your stocks are losing money before the new year, you might want to take advantage of the possible Christmas rally, assuming there is one, even though the gains aren't huge, maybe just 1% or 1.5%. That's what history shows. So you might as well use this Christmas and New Year period. And if you have some weak or stuck stocks, it's better to take this opportunity during the rebound to weed out the weak and keep the strong. If your stocks are all profitable and the gains are pretty significant, then just let them be. You don't necessarily have to sell. Or you could take partial profits, like selling 1/2 or 1/3, and then buy back in if there's a pullback. So that's really how I see it. People often ask whether they should hold on to their stocks over the New Year holiday. Why only talk about holding stocks over the New Year? Why not hold stocks over Mid-Autumn Festival or Qingming Festival? What's so special about holding stocks over the New Year? Personally, I don't think whether you hold stocks over the new year is all that important. You should always have some core holdings anyway. For example, you can keep 20%, 30%, or even 50% of your portfolio as core holdings to carry through the new year. You don't have to sell all your stocks, and there's really no need to do that. Because honestly, after the new year or after any holiday, who knows how the market will move? Honestly, it's really hard to say, really hard to predict. Even if after the new year the index does hit new highs, if the stocks you bought aren't the ones making new highs, or if you're not holding the leading sectors, then it doesn't really matter. Or maybe the company you bought has been stuck in a slump for the past year, or even losing money. For example, maybe some traditional industry stocks, like in Taiwan, we're talking about traditional sectors. Or in the US, you might have accidentally bought something like Nike. Or maybe you bought some more unusual companies that haven't hit new highs in the past year, which can be tougher. So I think whether you should hold on or not, what you really need to consider is what kind of company you actually own. The kind of company you hold will determine whether you should keep your stocks over the new year. This is a more long-term perspective, just something for everyone to think about. So there's no absolute right or wrong here, it's just a matter of choosing your own trading strategy. Now, regarding geopolitical risks, Zelensky said something about a 20-point peace plan for exports, and that it's been completed. Although it's not perfect, the core objectives have been achieved. Blah, blah, blah. A lot of things like that. You've probably seen this already. Then the EU said that sanctions against Russia will be extended for another 6 months. Basically, it just keeps getting extended all the way to next July. I'm wondering if these sanctions on Russia will keep getting extended even past next year's US midterm elections. Maybe they'll still be going on. As for the Ukraine-Russia negotiations, we'll just have to keep watching. I don't think it'll be resolved anytime soon. It's just stuck there for now, and nothing has changed. The war has been going on for about 3.5 years, and next year will be the 4th year. It's really sad. The people are suffering. Anyway, the talks will just keep dragging on. Now, you might ask, teacher, why did oil prices go up from yesterday to today? There was a small rebound, pushing prices above $58. There are a lot of reasons for this. It's not just one thing. The situation between Ukraine and Russia actually has nothing to do with this. So about this, according to the Associated Press, the U.S. Coast Guard is stepping up efforts to intercept cruise ships in the Caribbean, putting pressure on Venezuela. And as for Venezuela, in their country, I saw some photos, and honestly, it's really like the situation where the arrow is already on the bow and has to be shot. Everyone's on edge, like startled birds. As for Venezuela, their president, well, basically, they're just... Anyway, that's how it is. Their efforts to combat drugs don't seem to be very effective, and that's made Trump unhappy. So Trump wants to use maritime operations, attacks at sea, or even possibly ground operations to wipe out these drug lords. As for the escalating situation in Venezuela, when we look at those photos, it's really quite something. I think they're worried the US might attack them, so they've issued, "Every citizen has a gun." Oh, that boss. What was it? NK something. I forgot the model of the rifle. Anyway, everyone is carrying a rifle, right? Even the elderly, the weak, women, and children all have a gun. You see an old man or a gray-haired old lady, and they're holding a gun in their hands. Why? Because everyone has to come together to defend their homeland. Of course, defending your homeland is understandable, that's for sure. Sometimes I wonder if one day Taiwan will be like this too. It's hard to say. Maybe everyone will be given a gun to defend their homeland. It's possible. But of course, it's best if it never comes to that. So, regarding Venezuela, another thing people think about when it comes to investing is, if the US were to attack Venezuela, would that cause oil prices to rise? I think gold prices would go up, actually. There would be a demand for gold as a safe haven, and gold prices would rise because of increased geopolitical risk. But as for oil prices going up, I think there might be a short-term boost, but in the long run, the supply and demand issues for crude oil are still pretty significant. So in the short term, oil prices might be affected by Venezuela, maybe rebound a little bit, get a slight boost. But if you're asking whether they'll rebound a lot, no, not right now. Why? First, because of the supply and demand issue I just mentioned. Second, Venezuela's oil production, in fact, under the sanctions imposed by the Trump administration, its oil production, actually, in terms of global oil output rankings right now, I remember according to the latest data this year, it's probably only around 20th place, ranked about 20th in the world. So it's way, way down the list. Its daily oil production is reported to be 100,000 or 150,000 barrels a day. Anyway, it's really low. That's the key point. So if Venezuela really were to fall into turmoil, would the supply of crude oil be greatly affected? No, because it already has almost no significant impact. It would just be a short-term, so-called speculative topic that might cause oil prices to rebound a little bit. Geopolitical risks. Ukraine and Russia will negotiate next year. Venezuela might give oil prices a small boost, but not long-term. Keep an eye on it. Israel-Hamas, less need to pay attention for now. We'll discuss next year. Crude oil prices fell 0.12% today, remaining relatively weak. So at 8:30, we'll take a look at the relevant economic data together. Yeah, the economic data. All right, let me see. Walking around New York, there are black people everywhere. I know that in Cocoa, it seems like everyone either lives in New York or somewhere else in the US, right? Oh, this might have something to do with the way the Democrats and Republicans handle public safety or their approach to governance locally. People who actually live there probably know more about it. If any of you have lived in the US for a long time, feel free to share your experiences about things like the economy, prices, or even the natural environment. Just anything relevant. By the way, what do you think about Xingqingdan 2.0? What do you think about Xingqingdan 2.0? Sai, this thing, I think it's like this. When Xingqingdan first came out, the idea was about real estate, right? They wanted to boost the real estate market. Everyone thought, young people would all have money to buy houses. But honestly, this is a huge issue. There are a lot of problems. A lot of the Xingqingdan quotas, a big part of them were actually used by investors who used the names of people eligible for Xingqingdan to do what? To invest. So later, when the central bank investigated, they found out that a lot of these quotas were being misused. They used fake accounts or operated under the names of so-called investors and so on. And then, originally, the government's intention with Xingqingdan was good. They wanted young people to have homes. But in many places, it ended up becoming a tool for investors to speculate. As for whether this Xingqingdan policy is good or bad, I think it really depends on your perspective. Because actually, housing prices in Taiwan are really, really high. Because of this, a lot of people simply can't afford to buy a home. So when the Xingqingdan policy was introduced, it offered higher loan-to-value ratios and lower interest rates. But if you do the math, since housing prices are already so high, and then the new policy stimulates demand even more, people start chasing after houses again, which pushes prices even higher. So when housing prices are already sky high and then go even higher, young people who actually try to buy a home, I'm not sure if you know any young people in this situation, when they really go to buy a house, they run into a problem. They can technically afford to buy, but the monthly mortgage payments, the burden of the mortgage becomes extremely high. Why? Because housing prices have shot up again. With higher prices, the down payment required is also higher. On top of that, your interest rate, your monthly principal and interest payments, since the price is higher, what you have to pay each month is even more. So for some people who buy under the new first-time homebuyer program, you often hear that those who use this program to buy a house might use a grace period for the first 3 or 5 years. That means you only have to pay the interest. But after 5 years, once the grace period ends, it becomes really hard to pay both principal and interest. And the burden is huge, or it makes your quality of life much worse. So is the first generation of the first-time homebuyer program really good or not? Maybe for housing prices and developers? I think for housing prices. Driving prices up is a good thing for those of us who already own property. And then for developers and people selling land or houses, it's also a good thing because they make more money. So what about the so-called Xingqingdan 2.0? What kind of impact will it really have? I think there are still a lot of uncertainties. A couple of days ago, I saw a news report where the central bank governor was talking about how they want to set a cap on the total amount of mortgages and who should get the priority for these loans. They want all of it to be handed back to each bank for their own assessment. Wow. So how much is the total loan amount? I think with this, the current housing prices probably won't be easy to suppress in the short term. After all, trying to bring down housing prices affects so many different areas. It impacts the economy, people who already bought homes, developers, elections, financial backers, and politicians. So the scope of the impact is really, really broad. All we can say is if you have the opportunity and your financial situation allows, then maybe buying a house is an option. But if housing prices are just too high and you really can't afford it, don't force yourself to buy. You shouldn't take on such a heavy burden that your quality of life suffers. In that case, you might as well invest in stocks instead. Investing in stocks because maybe stocks Stocks, e.g. in 2023, 2024, 2025, and even 2026, stock returns may exceed housing price increases. In 2023, 2024, and 2025, growth averaged 20 to 30%. Both the Taiwan and US stock market saw 20-30% increases. So just think about it. If you're getting 20% to 30% returns and you invested in stocks for these 3 years, your capital, your assets would have already doubled. If you average a 25% return each year, your money will definitely double in 3 years. So it might actually be better than buying a house. Of course, this is just for reference. Housing prices are always a hassle. Lots of people can't afford to buy, and if you can't afford it, well, someone mentioned living in New York for 30 years and seeing the situation in the US get worse and worse. Yes, there are a lot of factors that can be affected. Now, regarding May's question, the commenter mentioned that Democratic officials are corrupt internally, but honestly, not just Democrats, but Republicans too. Politicians everywhere are corrupt to some extent. Why does the US lower interest rates, but our mortgage rates never go down? Regarding the question about the US lowering interest rates, well, in the US, mortgage rates are already really high, like 6 or 7%, which is quite high. That's because previously the interest rates in the US the central bank's interest rates were high, above 4%, but recently they've decreased. As for interest rates in Taiwan, Taiwan's interest rates have always been low, around 2%. Compared to the US, ours have always been much lower. So if you say the US is cutting interest rates, should Taiwan keep lowering its rates too? Of course, lowering rates would definitely reduce costs for people paying off their mortgages, but there's a problem. If mortgage interest rates drop even further, if mortgage interest rates drop again, I'm talking about Taiwan here. If the profit margin drops further, what will happen to housing prices? They'll shoot up again. If housing prices surge, then the central bank's original policy to curb the housing market and suppress prices will be even less effective. So will the current 2% interest rate from Taiwan's central bank go down any further? I think it should, but the chances are slim. It would only go lower if the economy takes a downturn. Right. Unless the economy goes into a recession. Otherwise, it's really hard to lower it. I'm talking about Taiwan here. Wow, as we keep talking, it's already 8:30. 8:30, time to switch gears. What data are we looking at? It's the data from just now, the 9:30 numbers. Let's take a look at third quarter GDP. The initial estimate for the annualized growth rate of the US third quarter GDP just came out, and it's pretty impressive. It shot up to 4.3%. That's impressive. The 4.3% is higher than the previous figure and above the expected 3.3%. Personal consumption expenditures also came in at 3.5%. So consumer spending looks great. If overall US consumer spending is strong, then GDP and related data won't look bad. As for the core PCE data, it came in at 2.9%, which matches expectations. It didn't spike much. Although it's higher than the previous 2.6%, it's right in line with the forecast. Now, regarding US durable goods orders for October, the monthly rate actually dropped to 2.2%. So looking at everything as a whole, I think the data released at 9:30, whether it's GDP, consumer spending, or even the more important figures like core PCE, all look pretty solid. Although the monthly rate for durable goods orders was worse than expected, coming in at minus 2.2%, overall, looking at the newly released US economic data, honestly, it's actually pretty good, really good, quite solid, and even quite robust. I think it's much better than expected, really much better than expected. So we can only say that the US economy hasn't gone into a recession. Of course, looking at it from another angle, it's precisely because the US economy hasn't experienced a hard landing or gone into recession that next year's monetary policy may not necessarily. There will be many rate cuts because the economy is doing well. If the economy wasn't doing well, you'd need to cut rates. But if the economy is as he described, 4.3% GDP growth and consumer spending surging to 3.5%, then why cut rates next year? So the rate cuts next year may not be as high as expected. Of course, these are just the data released tonight. Moving forward, there will be new data coming out in January, February, and March next year. The new data will include things like inflation and employment figures, so we'll track those one by one when the time comes. The final situation might sometimes be higher, sometimes lower, and that will continue to affect the Federal Reserve's monetary policy adjustments. At least based on tonight's data, it shows that the US economy hasn't had a hard landing and is performing very well. For the stock market, this is relatively positive. It's more on the favorable side. However, when it comes to monetary policy, it means that there might not be a need to cut rates so aggressively. So this is basically the concept of a seesaw effect. All right, that wraps up the data section for everyone. Now, moving on to earnings reports. As we mentioned yesterday, we'll revisit the earnings reports in mid to late January. Financial stocks will be the first to report. Also, someone mentioned that with interest rates in Taiwan being so low, it's basically impossible for them to go any lower. Yeah, exactly. If rates go lower, it'll just fuel speculation in real estate and everything else. Everything will get hyped and out of control. The stock market could even skyrocket. Let's look at the industry side. Regarding Nvidia, the short seller Michael Burry has again criticized Nvidia. What's his criticism? Basically, he'll criticize anything he can since he's shorting it. His short position is more of a long-term one. I think it's either long-dated options or futures, so he's betting against it further out. Was it 2027? I forgot the exact number. Anyway, what did he say? He questioned whether Nvidia is leading the way down a high energy consuming, unsustainable AI path, and he warned that this could cause the US to lose out to China in the AI race. He said that China is way ahead of the US when it comes to the development and layout of power infrastructure. So when it comes to developing these more energy intensive AI chips and facilities, China might have the upper hand. It's possible that China's support in terms of electricity will be safer than the US. So what Michael Burry means is that Nvidia's chips are high energy consuming and require a lot of electricity. And in this competition, the US might lose to China because America's power equipment and infrastructure aren't as good or as rapidly developed as China's. But this idea of his, so his point is basically you shouldn't buy Nvidia, you should buy this other one. The efficiency is better. And then when it comes to chips with lower energy consumption, like ASICs, those are application-specific integrated circuits. He's saying that compared to NVIDIA's standard chips, because NVIDIA makes general-purpose chips, even though their efficiency is pretty good, their power consumption and energy use are both higher. And they're also more expensive. So what he means is, because of this background with layoffs, he suggests that everyone should buy SQL chips. But it's also pretty interesting. He's recommending that people look for targets among higher efficiency chips, or further develop those chips, namely Broadcom and Marvel, since those are the two biggest ones, Broadcom and Marvel. But Michael Burry didn't buy them either. That's just how it is. He also doesn't have the authority to tell everyone to buy Broadcom or Marvel, so I don't really know. Honestly, I have no idea. When he suggests people look into chips, he doesn't specify which company. He doesn't say. He just talks about his concerns. Anyway, looking at the whole thing, I think it's best to just listen and not take it too seriously. It's like that old saying, right? When it comes to competition in AI chips, it's the same old story. General purpose chips are like drills used in mining. If you want to drill, if you want to be efficient, if you want to dig out a lot of tunnels and extract a lot of minerals, you have to use a drill. And drills are naturally more expensive. The drill uses a lot of electricity, right? Understandably, it uses more energy, but it's also more efficient. The price of the equipment is higher. NVIDIA is producing these drills. If you want to use a chip to mine coal, gold, or diamonds, but you're just using a shovel, it's not the same. It's cheap, it doesn't use much electricity, and the equipment is lightweight and easy to carry. Plus, it's efficient and easy to handle. So you can go buy chips from companies that specialize in developing products for specific applications. That's why I think each has its own strengths and market. And just because of that, it doesn't mean one will completely replace the other. Today, when people discuss responding about how high energy consumption makes it hard to sustain AI, does that mean the US is clueless? Does the US government not know it needs to develop energy policies? When the US develops AI, do you think they don't realize they need to look into nuclear, solar, or other sources? What else do they need to consider? Can they provide enough electricity for these AI companies? That's impossible. So US policies can't just be for show, and their energy policies aren't just for nothing. So when Michael Burry says, wow, the US might lose to China, and high energy consumption is unsustainable, I don't think that's going to happen. I really don't think that's going to happen, because Trump basically knows about the situation too, so he won't let this happen. So when it comes to AI chips and AI development, he still wants the technology and this development to be led by the US, with the US taking the lead. So these kinds of concerns that people are talking about, I think in the next few years, they probably won't happen, because the US will definitely find other ways to counteract this issue. Because if you don't handle this well, if you really don't handle it well, just like what he said, if you don't take care of it, you make all these chips, all these great general purpose chips, even including companies like Marvel and Broadcom, which have really good SQL chips, all of these things need electricity. They all need power. So think about it. Is it possible that the US wouldn't make sure the power issue is handled? Of course they're going to take care of it. If you don't, how can you develop AI? So that's the point. You don't even need to worry about it. It's not the most important concern. So as for the response, yesterday I went up by 1.49%, and it wasn't affected by this mug issue at all. Oh, but just looking at the short-term technicals, I think if the 50-day moving average, this quarterly moving average, can really hold steady and stay above, then it will have a kind of turning effect on NVIDIA's consolidation period. But for now, as long as the 50-day moving average isn't holding steady, in the short term, over these 3 months, it's still more of a volatile consolidation phase, you know? Right now, it's still pretty much in a consolidation pattern, so just stick to buying low and selling high for your trades. let me add a bit more to the previous answer for everyone. Also, about Tesla, this news about Musk is pretty interesting too. Back in 2018, the Supreme Court of Delaware originally ruled against Musk's $56 billion sky-high compensation package, saying it was too much, so they opposed it and said it couldn't be used. But then, after a few years, after 7 years, Delaware said this compensation package was allowed. But it means nothing. Since 2018, 7 years have passed. Initially, he received $56 billion. Now it's nearly triple to $140 billion. Okay, so do you think this is the reason why Tesla's stock price hit a new high again yesterday, soaring to almost $500? Well, I don't think that's the main reason either. It's not really a big deal. I think the main thing is actually that Tesla, including things like its robots and so on. And then there have also been advances in robotics and self-driving taxis, and the autonomous driving features are making progress too. Plus, there's the development of AI and a lot of other things. And then there's SpaceX. SpaceX, yes, the space company. They're planning to go public with an IPO in 2026. Oh, so if this IPO happens, Musk's net worth will increase. It would increase by $600 billion, a crazy amount. His net worth could reach $1 trillion. So these ongoing developments in Musk's main businesses or side ventures are a huge driving force pushing Tesla's stock price to new highs. It's not about that $56 billion or the fact that suddenly got approved again. Bringing up something from 7 years ago doesn't really mean anything. Right now, what Musk cares about is no longer that $56 billion. On November 6th of this year, a $1 trillion compensation plan was already approved. What is this $1 trillion compensation plan for? It's to see how Musk manages Tesla and how his main inside businesses reach certain milestones. Every time he hits a milestone, he gets a certain amount of money. With each milestone reached, he gets paid accordingly. So this is what motivates Musk to seriously focus on running his main business, to stay away from politics, and to avoid making wild or bombastic statements. This is a huge reason why Tesla's stock price has reached new highs. As for this neckline, it already broke through this blue dashed line before we talked about it. The previous high point of this neckline, you can take a look at this chart. So you can estimate the money. It was sold at around 470 or 480, and the previous neckline had been broken. What happens after the breakout? If it holds above that level, it's a positive sign for the stock price. But most importantly, Musk needs to focus on running his core business well. If he manages the core business well, I believe the stock price will definitely reflect that fairly. That's about it for Tesla. Lastly, let's talk about Oracle. As for Oracle's stock price, hey, good evening, little donkey. Has Oracle's stock price actually been undervalued? Is it undervalued? In my opinion, the issue with Oracle's stock price isn't really about whether it's undervalued or not. Its stock price? It dropped from about $350, just plummeted since September this year, all the way down to around $170 or $180. That's almost a 50% drop, nearly cut in half in just 3 short months. So is $170 or $180 considered undervalued? Is it a low valuation? I think that's hard to say. Why? Because Oracle's biggest issue right now is the market sentiment. People think it's heavily in debt. And then the CDS, the credit default swap, rates have shot up really high, reaching levels we haven't seen since March 2009. It's the highest point since Lehman Brothers collapsed, so everyone is worried that they might not be able to pay back their debts. And then their third quarter financial report, just recently released, I remember that their revenue and profits were kind of a mixed bag. Both EPS and revenue were mixed. Some beat expectations, some fell short. As for their fourth quarter revenue outlook, at best, it just met expectations. But the most important thing is their cash flow. Their free cash flow actually went from negative $6 billion, usually it's negative $6 billion, to a huge jump to negative $10 billion. So that's what everyone is concerned about. They're worried about liquidity issues, that they can't turn their cash around. And on top of that, they're constantly investing in things like OpenAI, collaborating with NVIDIA, and trying to do all these things. Like the perpetual motion machine of Stargate's AI. You don't want this AI perpetual motion machine, right? It hasn't even started running yet, and the machine is already breaking down, so that's what everyone's worried about. So is Oracle's current stock price overvalued or undervalued? I don't think we need to debate whether it's high or low. What we should be looking at is when they're going to fix that cash flow problem. If they can ease the market's concerns, the stock price will naturally go up. But if this issue isn't resolved and people are still worried that their free cash flow each quarter is between negative $6 billion and negative $10 billion, and in the fourth quarter it could become negative $12 billion, then this perpetual motion machine just won't turn. People are worried that if this thing can't keep running, no matter how low the stock price gets, nobody will want to buy it. This helps you understand the different implications. If this perpetual motion machine stops, if there's a problem with cash flow and the company can't keep things running, the stock price will just keep falling. But if the cash flow issue is resolved, the CDS ratio and interest rates go down, and people no longer worry about a debt default, then the stock price will just shoot right up and justice will be served. So everyone is focusing on this. They're focusing on that area because its impact is greater. So what did Wells Fargo say today? They said the market is overly pessimistic about AI investments and is seriously underestimating Oracle's value. So I think you can use this as a reference. What exactly is Oracle's value? How much is it really worth? You might calculate the PE ratio, the price to book ratio, estimate its future revenue, profit, EPS, and so on. Maybe you have a model to figure out what a reasonable investment price for Oracle is. But I think sometimes even a reasonable investment price can be overshot on the downside. It's also possible that the price will bounce back before it even reaches that level. So you can refer to a lot of reasonable investment prices calculated by various foreign institutions. But I think the most important thing is the market sentiment. That's actually the biggest factor that determines when Oracle's stock price will stop falling, not those indices or calculations. So according to Wells Fargo, the stock price could rise by 50% in the future, and their target is as high as $285. So will it go up? I think you should use it as a reference for now, and note the current trend is still relatively weak. The 50-day and 200-day moving averages and the 20-day moving average haven't been broken through. Once the price breaks above the 200-day moving average, reevaluate. Most importantly, as mentioned, the biggest concern about FCF needs to be addressed first. All right, as for the news today about Paramount and Skydance, just take a look at it for now. Basically, Paramount and Skydance were originally trying to acquire Warner Bros., right? And then, as we mentioned a while ago, Netflix also wanted to spend $82.7 billion to acquire Warner Bros., and Paramount was reportedly planning to spend nearly $110 billion in a hostile takeover attempt. In the end, it's still uncertain who will come out on top. It's even possible that Warner Bros. Might end up choosing Netflix, even though their offer is lower. So why do I keep mentioning that Paramount and Skydance are so eager to acquire Warner Bros.? It's because Warner Bros. Owns a lot of media assets, including many digital media outlets and other properties. But most importantly, they own CNN, which is a very significant news outlet under Warner Bros. Now, CNN has often reported negatively about Trump in the past, frequently covering unfavorable news about him. So why is Oracle involved in all this? It's because Paramount is actually owned by the son of Oracle's founder, Larry Ellison. David Davidson, this person, well, he's the one who, let's say, founded or invested in the company. So he's connected to Oracle because he's the son of Oracle's founder. That's why if he's putting up money, we're saying Oracle is also involved financially, because Oracle is one of the investors. In addition, Trump's son-in-law is also a very important investor in this Paramount deal. The reason, as I just mentioned, is all about political considerations. Everything is political. Next year, Trump is running for election. So of course, he wants these news media outlets to be on his side and help promote him. That's why Oracle is so proactive, why Paramount is so proactive, and why Trump's son-in-law is so eager to get involved. Warner Bros. Wants a piece of the action for the same reason. So this is entirely driven by political considerations. And of course, this is another side story about Oracle, since it's related. Now, going back to Oracle itself, as I just mentioned, yesterday it rebounded by 3.34%. But looking at the bigger picture, you should still treat it as a technical rebound after a steep drop, nothing more. The biggest fundamental issue remains its cash flow and revenue. All right, moving on to the US dollar and the stock market pre-market. Let's take a quick look at that. Huntington Ingalls Industries, specializing in building U.S. Navy warships, the largest shipyard for American warships. Its stock was up 5.2% in pre-market trading in the U.S. because they announced a new order for next-generation Navy ships. Albemarle Corporation was up 2.63% pre-market. Additionally, companies like Utah, Menlo, and Carnival were also up about 1% pre-market. As for the companies that dropped, there's Johnson & Johnson. This company saw its stock fall by 1.31%. Why? Due to baby powder issues, including cancer and insomnia concerns. This led to a $1.56 billion damages order. In addition, Disc also fell by 1.31%, and another company, NIO, dropped by about 1% as well. As for other companies that declined, like Quida, it only dropped by 0.35%, so not much. Overall, I think the market today is still more or less in a consolidation phase, with small gains and small losses. Why is that? Because Christmas is almost here. Tomorrow is Christmas Eve, and then it's Christmas Day, and after that, New Year's. So gradually, both foreign investors and institutional investors are starting to take breaks. As a result, trading volume is relatively low, and the market volatility is also lower. That's why the companies that are rising or falling are mostly just some relatively. These are companies that aren't really representative. We can only put it that way. As for the real high-tech giants, their performance during this period, this week, and even next week, I think will be relatively calm and quiet. Now, the Dow Jones Index, of course, is an important indicator of Trump's performance. The Dow rose by 0.47%, staying above the monthly and quarterly moving averages. The Philadelphia Semiconductor Index also rose by 1.1%, and likewise, it's above the monthly and quarterly moving averages. As always, keep an eye on the short-term pressure to take profits. If there's a new high, it's a good idea to sell and lock in some gains. If there's a pullback, just wait until it hits the moving average and then buy in at a lower price. As for the Nasdaq index, it continues to move steadily, with a slight increase of 0.54% yesterday. Of course, in the future, next year and even into 2026, the 7 tech giants will still need to lead the entire index. Whether it's the international stock market or not, these giants are a very important confidence indicator and leaders for the market. Alright, that's all for the English language segment, bringing you the latest updates before the US stock market opens. When class is over, remember to like, subscribe, and share for us. If you or your friends have any questions, feel free to leave me a comment. Finally, I wish everyone smooth trading. See you next time. That's the end.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.